When Charlie Munger died in 2023 at age 99, his personal portfolio held exactly three major stock positions. While everyone else diversified across dozens of companies, he concentrated on three and built $2.6 billion. Today, we're breaking down the three-basket rule that made it possible. Picture a Berkshire Hathaway shareholder meeting sometime in the early 2000s. 15,000 investors packed into the arena. Warren Buffett's at the front table. Charlie Munger's next to him, slouched in his chair, wearing his signature thick tortoiseshell glasses. Someone in the audience stands up, microphone in hand, nervous energy. They ask the question every financial advisor in America would tell you to ask. Mr. Munger, how many stocks should I own to properly diversify my portfolio? The room goes quiet, everyone leans forward. This is conventional wisdom territory, modern portfolio theory, diversification as the only free lunch in investing. You're supposed to own at least 20 stocks, maybe 30, spread across different sectors to minimize risk. Charlie looks at the questioner, doesn't hesitate. We have three baskets for investing, he says. His voice is matter-of-fact, almost dismissive of the complexity others bring to this question. Yes, no, and too tough to understand. The audience laughs, but Charlie's not joking. Most investors would be better off with a few outstanding investments rather than a diversified portfolio of mediocrity, he continues. If you're an investor who's actually intelligent, you should want to put your money in the handful of things you understand best. At this moment, Charlie Munger personally held three major stock positions. That's it. 3, not 30, not 20, 3, Berkshire Hathaway, Costco Wholesale, Daily Journal Corporation. And here's what makes this absolutely wild. That concentration wasn't recklessness. It was the culmination of decades of thinking about how intelligent capital allocation actually works. It was a philosophy that generated 19.8% annual returns during his investment partnership years. It was the same approach that helped build Berkshire Hathaway into one of history's most successful companies. Today, we're breaking down exactly why Charlie Munger rejected the conventional wisdom on diversification and how his three-basket rule completely changes how you should think about investing. I'm Michael, and this is The Wisdom Investor. For the last 12 years, I've been obsessively studying Charlie Munger's investment philosophy, and I've got to tell you, the three-basket rule might be the most misunderstood piece of wisdom he ever shared. Everyone quotes it. Almost nobody actually applies it. And when you dig into what Charlie actually meant, it completely flips modern portfolio theory on its head. So let me take you back to where this philosophy actually came from. Because Charlie Munger didn't just wake up one day and decide to concentrate his portfolio. This was a conclusion he reached after decades of studying investment results, psychological biases, and the actual mechanics of how wealth compounds over time. 1962. Charlie's 38 years old. He's been practicing law in Los Angeles, doing well, making good money, but something's been bothering him. He's been watching his clients get rich through real estate and business investments while he's billing by the hour. The math doesn't work. Trading time for money has a ceiling. Capital has no ceiling. So Charlie does what Charlie always does. He studies the problem. He reads everything he can find about investing. Benjamin Graham's work on value investing. Phil Fisher's approach to growth companies, academic research on market efficiency, and he starts noticing patterns that nobody else is talking about. Here's what actually happened. Charlie started an investment partnership, Wheeler, Munger and Company. He raised money from friends, family, people who trusted him, and right from the beginning, his approach was different from what everyone else was doing. Most investment funds at the time were following the diversification playbook. Own 20 to 40 stocks, spread your bets, reduce volatility. The theory made sense on paper. If one stock crashes, it doesn't kill your portfolio. You're protected by all the other positions. But Charlie looked at that approach and saw something nobody else wanted to admit. When you own 40 stocks, you're guaranteed to own a bunch of mediocre businesses. You can't possibly know 40 companies deeply enough to have real conviction. You end up owning things because they seem okay, or because they provide sector exposure, or because some analyst wrote a report saying they're undervalued. Charlie called this diversification. You're not diversifying, you're making your portfolio worse by adding businesses you don't understand. So here's what he did instead. He concentrated. During the 13 years he ran his investment partnership from 1962 to 1975, Charlie typically held between 5 to 10 positions, sometimes fewer. These weren't random stock picks. These were businesses he'd studied extensively. Companies where he understood the economics, the competitive advantages, the management quality, and the long-term prospects. And get this, the results were absolutely insane. 19.8% annual returns over 13 years. The Dow Jones during the same period, 5%. Charlie wasn't beating the market by a small margin. He was crushing it by nearly 4 times. Now, here's where the 3-basket rule comes in, because Charlie wasn't just randomly picking a few stocks and hopping for the best. He had developed a systematic framework for thinking about every single investment opportunity that came across his desk. Basket 1, yes, these are the investments where everything lines up. You understand the business model deeply. It's within your circle of competence. The company has durable competitive advantages. Management is excellent. The price is reasonable or better. You can articulate exactly why this business will be worth significantly more in 5 to 10 years. When you find a yes investment, Charlie's philosophy was simple. Bet big. This is where you put meaningful capital to work, not 2% of your portfolio, not a starter position. If you've done the work and you truly understand why this is a great business at a good price, then treat it like the rare opportunity it is. Charlie applied this to Berkshire Hathaway. He applied it to Costco, where he served on the board for years and understood the business model intimately. He applied it to Daily Journal Corporation, which he chaired. These weren't speculative bets. These were businesses he knew inside and out. Basket 2, no, this is actually the most important basket, and here's why. Most investors spend all their time trying to find the next great investment. They're constantly searching, constantly analyzing, constantly looking for opportunities. Charlie flipped that completely around. He spent most of his time figuring out what to avoid. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent, Charlie said. Think about what that means. He's saying the real edge in investing isn't finding brilliant ideas, it's avoiding terrible ones. The no basket includes businesses with bad economics, companies and industries with no competitive advantages where everyone's competing on price, businesses with questionable management, industries you don't understand, situations where the valuation makes no sense no matter how good the story sounds, companies with complex accounting that obscures what's really happening. Charlie was ruthless about saying no, absolutely ruthless, and this is where most investors fail. They can't stand watching opportunities pass by. They feel like they have to be doing something. They see other people making money in crypto or tech stocks or whatever's hot at the moment, and they convince themselves they need to get involved. Charlie watched entire bull markets pass him by without participating. Dot-com bubble in the late 90s, he mostly sat it out. He didn't understand the business models. The valuations made no sense, so he said no. And when it all collapsed in 2000 and 2001, he was proven right. But here's the third basket, and this is the one that separates truly intelligent investors from everyone else. Basket 3, too tough to understand. This is different from no. No means you understand the investment and you're passing because the risk-reward doesn't make sense. Too tough to understand means you're honest enough to admit there are things outside your circle of competence. Let me give you a specific example. Charlie was famously skeptical of cryptocurrency. He called Bitcoin rat poison and said crypto was like a venereal disease. Now, a lot of people heard that and thought Charlie just didn't get it. He was too old, too stuck in traditional thinking. But that's not what was happening. Charlie was putting crypto in the too tough to understand basket. Could crypto become a revolutionary technology? Maybe. Could Bitcoin be worth $1 million someday? Possibly. But Charlie looked at it and said, I can't value this using any framework I understand. The business model isn't clear. The competitive advantages aren't clear. I can't predict with any confidence what this will be worth in 10 years. So he walked away, and here's the brilliant part. By walking away, Charlie avoided the mental energy drain of trying to figure it out. He avoided the risk of investing in something he didn't understand, and he freed up his time and capital to focus on businesses he did understand. Now let's talk about what this actually looks like in practice. Because the three-basket rule isn't just about stock picking, it's a complete philosophy about how to think about capital allocation. When Charlie joined Berkshire Hathaway as vice chairman in 1978, he brought this concentrated approach with him, and it fundamentally changed how Warren Buffett thought about investing. Before Charlie, Warren was a classic Benjamin Graham disciple. Graham's approach was to buy cheap stocks. Cigar butts, as they're called, businesses that might be mediocre or even declining, but the stock price was so low that you could buy them, collect the assets, and make a decent return. Charlie pushed Warren in a completely different direction. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, Charlie told him. This became one of the most important shifts in Berkshire's history. Let me give you the specific example of See's Candies. 1972. See's is for sale. It's a California-based chocolate company with amazing brand recognition and pricing power. The asking price is $30 million. The company's book value, the actual physical assets, is only $7 million. By Graham's standards, this was a terrible investment. You're paying more than 4 times book value. That violates every rule in the value investing playbook. But Charlie looked at it differently. He saw a business with incredible economics. See's could raise prices every year without losing customers. People bought See's chocolates as gifts. It had brand loyalty that couldn't be replicated. The capital requirements were low. It generated cash that could be reinvested elsewhere. Charlie convinced Warren to pay the $30 million, and here's what happened. Over the next 50 years, See's Candies generated almost $2 billion in pre-tax earnings for Berkshire Hathaway while requiring minimal additional capital investment. That $30 million investment returned more than 60 times. This is what concentrated investing on quality businesses actually looks like. You're not trying to own a little bit of everything. You're trying to own meaningful stakes in exceptional businesses that compound value over decades. Now, here's where this gets really interesting from a psychological standpoint, because the three-basket rule isn't just about finding good investments. It's about managing your own psychology. Think about what happens when you own 40 stocks. Some go up, some go down, some do nothing. You're constantly monitoring, reading news, checking prices, worrying about sector rotation and market timing and rebalancing. It's exhausting. And worse, it's distracting you from the only thing that actually matters, which is understanding the underlying businesses. But when you own 3 to 5 positions that you deeply understand, everything changes. You're not reacting to market noise. You're focused on the fundamental question: are these businesses getting stronger or weaker? Is management making good capital allocation decisions? Are competitive advantages widening or narrowing? Charlie used to say, investing is where you find a few great companies and then sit on your ass. That's not laziness, that's discipline. It's recognizing that most activity in investing is counterproductive. The more you trade, the more you pay in taxes and fees. The more you react to short-term news, the worse your long-term results. Let me take you through how this actually worked in Charlie's personal portfolio toward the end of his life, because this is where the philosophy got distilled to its absolute essence. Charlie's 3 major holdings were Berkshire Hathaway, Costco Wholesale, and Daily Journal Corporation. Let's break down why each one made sense in his framework. Berkshire Hathaway was obvious. This was the company he helped build over 50 years with Warren Buffett. He understood every business Berkshire owned. He'd been involved in every major acquisition decision. He knew the culture, the management approach, the capital allocation strategy. This was as deep inside his circle of competence as anything could possibly be. Costco was different but equally clear. Charlie served on Costco's board for years. He watched how the business operated. He understood the membership model. He saw how Costco created value by keeping margins incredibly low, which built customer loyalty, which drove membership growth, which created a moat competitors couldn't cross. The economics were transparent. The management team led by Jim Seingle and then Craig Jelinek was exceptional. Charlie could see exactly why this business would keep compounding for decades. Daily Journal Corporation was the smallest position but perhaps the most telling. Charlie was the chairman. This was a newspaper and software company based in Los Angeles. The newspaper business was declining, but Charlie was overseeing a transition into court case management software. He was intimately involved in the strategy. He understood the economics. He could see the progress and setbacks in real time. Notice what's missing from this portfolio. No tech stocks beyond what Berkshire owned. No crypto, no commodities, no international diversification strategy, no bonds, no complex derivatives, nothing outside his circle of competence. And here's what I find absolutely fascinating. Charlie wasn't some reckless gambler who got lucky with a concentrated portfolio. His concentration was the result of extreme conservatism. He only invested when he was certain he understood what he was buying. Let me give you the counterexample. In the 1990s, a lot of value investors got destroyed because they refused to buy technology stocks. The narrative was that they were too old, too stuck in their ways, couldn't understand the new economy. But Charlie didn't avoid tech because he was old-fashioned. He avoided most tech because he couldn't value it with confidence. The business models were changing too fast. The competitive dynamics were unclear. The accounting was often aggressive, so he put it in the too tough to understand basket. But notice, Berkshire Hathaway eventually made massive investments in Apple. Why? Because by the 2010s, Apple had transformed from a pure tech company into a consumer brand with recurring revenue from services, a loyal customer base, and clear competitive advantages. The business model had matured enough that someone using Munger's framework could understand it and value it. That's the discipline. Wait for clarity. Wait until something moves from too tough to understand into, yes, I get this. And if it never moves, you never invest. No FOMO, no pressure to participate in every trend. Now let's talk about how this applies to you, because here's the thing. Most people hear about Charlie's concentrated approach and they think, great, I should just buy 3 stocks and hold forever. That completely misses the point. The concentration isn't the strategy. The concentration is the result of the strategy. The strategy is only investing when you have genuine understanding and conviction. So here's how to actually apply the 3-basket rule. Start by making a list of every investment you currently own. I mean everything. Stocks, funds, crypto, real estate, whatever. Write them all down. Now go through each one and ask yourself, do I deeply understand how this investment makes money? Can I explain the business model to someone else? Do I know what the competitive advantages are? Can I articulate what could go wrong and why I'm comfortable with those risks? Be honest, brutally honest, because here's what happens to most people. They realize they own a bunch of stuff that's in the too tough to understand category. They bought a stock because someone recommended it. They invested in a fund because it had good past performance. They bought crypto because everyone else was doing it. That's not investing, that's speculation, and the first step in applying Munger's philosophy is recognizing the difference. Once you've identified what you truly understand, the next question is, does this investment belong in the yes basket? Is this a quality business or asset at a reasonable price where you have conviction it will be worth substantially more in 5 to 10 years? If the answer is yes, then here's Charlie's advice. Bet meaningfully, not recklessly, but meaningfully. If you've done the work and you truly understand why this is a great opportunity, don't nibble around the edges with a 1% position. If the answer is no or too tough to understand, then sell it. And here's where most people struggle. They can't bring themselves to sell at a loss. They can't admit they made a mistake. They hold on to investments they don't understand because they're hoping they'll eventually break even. Charlie would say that's insane. The question isn't what you paid for something. The question is whether it deserves to be in your portfolio today based on what you know now. If it doesn't clear the bar, sell it and move on. Let me give you one more specific example of how this played out in Charlie's career. Wheeler, Munger and Company, his investment partnership, had a relatively rough year in 1974. The market crashed. The partnership was down. Investors were nervous. Charlie could have diversified. He could have spread his bets wider to reduce volatility. He could have bought more positions to smooth out the returns. He did the opposite. He concentrated even more into his highest conviction ideas. And the following year, the partnership roared back with massive gains. Why? Because Charlie understood something fundamental about concentrated investing. When you own quality businesses purchased at reasonable prices, short-term volatility doesn't matter. In fact, it's an opportunity. If the stock price drops but the underlying business is getting stronger, you should be buying more, not selling in panic. But you can only have that conviction if you truly understand what you own. If you're diversified across 40 stocks, there's no way you can track all those businesses closely enough to know whether to buy more during a crash or whether something fundamental has broken. This is why the three-basket rule isn't just about stock picking. It's about building the kind of deep understanding that allows you to be rational when everyone else is panicking. Here's another dimension of this that I think people miss. The three-basket rule applies to your time and attention, not just your money. Think about how much mental energy people waste on investments they don't understand. They're constantly reading articles, checking prices, watching financial news, trying to figure out what's happening with their portfolio. They own 20 stocks and they can't really tell you what any of them do or why they'll be more valuable in 5 years. Charlie's approach freed up all that mental energy. When you own 3 to 5 positions you deeply understand, you're not constantly worried. You check in periodically to see if the fundamentals are still intact, but you're not glued to the screen watching every tick. That freed time, Charlie spent it reading, learning, expanding his circle of competence, building his latticework of mental models. That's how he kept getting better as an investor even into his 90s. Let me address the obvious counterargument. What about risk? Isn't a concentrated portfolio more risky than a diversified one? This is where Charlie would push back hard on conventional wisdom. He'd say it depends entirely on what you mean by risk. If you define risk as short-term volatility, then yes, a concentrated portfolio is riskier. If one of your 3 stocks drops 30%, that's going to hurt your portfolio more than if you owned 30 stocks and one of them dropped 30%. But Charlie didn't define risk as volatility. He defined risk as the permanent loss of capital. The real risk isn't that your stock price fluctuates. The real risk is that you invest in a business you don't understand and it permanently destroys value. From that perspective, owning 40 stocks you don't really understand is far riskier than owning 3 you understand deeply. With 40 stocks, you're almost guaranteed to own some that are garbage. You just don't know which ones because you haven't done the work to understand them. With 3 stocks you understand deeply, you've eliminated the risk of ignorance. You might still be wrong about the future, but you're not wrong about the present. You know what you own. Here's the practical question everyone wants answered. How many positions should you actually own? Charlie's answer would be, it depends on how many you can truly understand. For most people, that's probably between 3 and 10, maybe fewer if you're just starting out, maybe a few more if you've spent decades building expertise in specific industries. But here's the key. The number isn't the point. The point is that every single position in your portfolio should pass this test. Can you explain in detail why this business will be worth more in 10 years? If you can't, it shouldn't be in your portfolio. Let me tell you what happened when Charlie was asked about this at a Daily Journal Corporation shareholder meeting. Someone asked him how many stocks the average investor should own. Charlie said, if you're capable of understanding 5 great businesses, you're probably capable of understanding 10, but I will guarantee you're not capable of understanding 200. The more you diversify, the less you know about each investment. Think about what he's saying. The constraint isn't some arbitrary number. The constraint is your own capacity for deep understanding. And for most people, that capacity maxes out somewhere between 5 and 15 businesses. Beyond that, you're kidding yourself that you really understand what you own. Now let's talk about the hardest part of all this, actually having the discipline to say no and to say too tough to understand. I've been studying Charlie's career for 12 years, and I can tell you the opportunities he passed on are just as important as the ones he took, maybe more important. During the dot-com bubble, tons of value investors abandoned their principles and bought tech stocks because they couldn't stand watching their portfolios lag. Charlie didn't. He stuck to what he understood, and when the bubble burst, he was vindicated. During the housing bubble of the mid-2000s, everyone was getting rich flipping real estate. Charlie stayed focused on quality businesses. When the financial crisis hit, he was in a position to buy, not desperately trying to sell. During the crypto boom, younger investors made fortunes in Bitcoin and Ethereum. Charlie called it rat poison and sat it out. Right or wrong, he was consistent with his principles. If he didn't understand it, he didn't invest. That discipline is incredibly hard. It requires being comfortable missing out. It requires being okay with your friends making money in investments you don't own. It requires focusing on your own process rather than comparing yourself to others. But here's what that discipline buys you: peace of mind, clarity, the ability to sleep well at night because you know what you own and why you own it, and ultimately better long-term results because you're not constantly chasing the latest hot investment. Let me wrap this up with the big picture. The three-basket rule isn't really about the number of stocks you should own. It's about developing the wisdom to know what you know and what you don't know. Charlie spent his entire life building what he called a latticework of mental models. He studied psychology, economics, mathematics, physics, biology, engineering, history, philosophy. He read voraciously. He learned from his mistakes. He built a framework for thinking about the world that allowed him to evaluate opportunities across multiple domains. And even with all that knowledge, he still said no or too tough to understand to most investment opportunities, because he recognized that competence has boundaries, and the most dangerous thing you can do is pretend you understand something when you don't. So here's what I want you to take away from this. The three-basket rule is an invitation to think more deeply about what's actually in your portfolio and why. Start by being honest about your circle of competence. What do you genuinely understand? What industries have you studied for years? What business models can you explain in detail? That's where you should be investing. Everything else, basket 2, no, or basket 3, too tough to understand. And that's okay. In fact, that's the whole point. By narrowing your focus to where you have genuine understanding, you dramatically improve your odds of long-term success. Charlie Munger died with 3 major stock positions and $2.6 billion, but the money wasn't the achievement. The achievement was the clarity, the discipline, the wisdom to know what deserved his attention and capital and what didn't. That's the lesson, not that you should own 3 stocks, but that every investment in your portfolio should represent genuine understanding and conviction. If it doesn't clear that bar, it doesn't belong. Now I want to hear from you. When you look at your current portfolio, how many positions can you honestly say you deeply understand? How many would pass Munger's 3-basket test? Drop a comment below and let's discuss. If you found this valuable, hit that like button and share this episode with someone who's interested in investing and clear thinking. It really helps us reach more people who can benefit from Charlie's wisdom. We release new Charlie Munger episodes every day on the Wisdom Investor, so subscribe and turn on notifications so you never miss an episode. I'm Michael, this is the Wisdom Investor, and I'll see you in the next one.